Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. We're going to rip through Twitter, see what people are talking about on Twitter. It's going to be wealth related, finance related, or commodity related information. I'm going to give you my financial opinions. If you like those financial opinions, you should definitely check out finding-value.com as we're running a 50% discount. Use the coupon code August for that coupon code if you'd like. And if you want to follow me on Twitter, it's at finding_finance. So those are the two. We got SPUT. SPUT breakout in the States. This is SRUUF. Breaking out. There we go. Ripping it. I think some positive things are going to be coming for uranium at some point or are already occurring. We've broken out of the patterns for a lot of the falling wedges, and we're just waiting for liftoff. That's my view on a lot of the junior companies. Camco, it's already in progress. Josh Young, global primary energy consumption continues to grow rapidly from almost all sources. Even coal use hasn't peaked yet. Just because a forecast comes from a reliable or very expensive source doesn't make it likely. Guys, if we're growing at exponential speeds, we are going to have to grow our energy sources at exponential speeds. I don't think solar and renewables are going to make a single dent in anything. We are going to ramp everything we can as fast as we can to meet the wealth and the wants and desires of humans to become wealthier. And wealth is a derivative of energy consumption. Bar none, period. If people in poorer countries want to become wealthier, they are going to burn more barrels of oil per person, period. Or consume more energy per capita, period. So this is going to have to continue to grow at an exponential clip. Now, I don't think that can happen, which means at some point energy is going to get very expensive if we cannot grow it at exponential speeds. Coming on down to Grady, he says, it's not often that a chart blows my mind after almost 3 decades in the markets, but this one just did. I mean, if silver is a clear 15x from here, which I really do think, imagine where platinum would be if this ratio goes back to all-time highs. Think we're going deep into the wild. So this is platinum versus silver on a yearly candlestick chart. 82 was a huge bottom against silver, platinum versus silver. And we had another huge bottom in 2020. Are we going to see an outperformance of platinum against silver of a 5x? So it says when this chart moves up, platinum outperforms silver. If we go back to 140 or so ratio, kind of up towards this top here, 130, something like that, we are at 40. So in order to go all the way to the top, you're going to have to outperform silver by 4 or 5x. I don't even know what that means if silver doesn't 15x. I mean, you're talking 50x from the current platinum price. Maybe. I don't know. Is that a possibility? It's a possibility. That's not a prediction. But what is weird is platinum is cheap against all of the other metals. People are going to say, well, what's the catalyst? I'm going to tell you this, guys. Here's the secret. No one knows. It's going to happen. And I think platinum's going to get more expensive. I don't know if it's going to go all the way to the top. My guess is it will against silver and other commodities. And no one's going to know until it becomes very obvious. Maybe something in South Africa happens. Maybe something in Russia happens. And the majority of platinum comes from those two countries. Scrolling down, we've got URNM. URNM is a uranium ETF. It says, here we go again. Oh, man, look at this, guys. We're right up against resistance if you draw the trend line or the resistance line going across. And we're just stuck on that resistance right now. We're about to break. We're about to rip it. I hope that it comes and occurs. I am well positioned for it. Let's make this baby happen. I like this. Lights out, baby. Let's go. It says if you make $20 an hour, that night out isn't $300. It's 15 hours of your time or 2 days of work. If you make $20 an hour, that car isn't 50,000. It's 2,500 hours of your time or 357 days of work. Time is your most valuable asset. Don't waste it. You know what I try to do? I try to maximize my dollars per hour. I try to maximize my pay per time unit. A lot of people, what they do is they take these jobs that require a lot of work, but they get paid more money. The problem is they are not getting paid more dollars per hour. And that is where I get a little bit chapped when I look at some of the positions that are around me. I want to maximize my dollar per hour. I don't necessarily want to work 60 or 70 hours a week and only get $10,000 or $20,000 more a year. That isn't worth it to me. So the gain here is how do you maximize your dollars per hour? And I'm going to go over another thing down below of why some investments do very well. And in real estate is what I'm talking about. And I'll go over that later. Here's Justin. He says, just when we warm up to the emerging narrative, the bull is ready to run. The market gods chuck a monkey wrench at us. Earlier this year, it was the wall of worry. And last week, it was a bond yields lurching higher. This is the yield curve. So this is the 10-year yield curve down here. It is very negative. When this starts to come back up and really start to make some headway to the upside, that's when we need to worry about a crash. That means people are running into bonds. But right now, if you look at the yield curve here, this is the 30-year nominal yield. You can see that we're breaking to the upside. Is that a sustainable breakout? Are we going to go much further to the upside? I don't know. That's yet to be seen, and we're going to have to find out. And that's what I think a lot of people are looking at. Interesting development in silver. We have a series of inverted head and shoulder patterns on the 2-year chart. These are normally bullish patterns that resolve in higher prices. Outlined below is a series of longer-term setups from red to green to blue. So this is the head. Here's the shoulder over here. And hopefully this is one big inverted head and shoulders that we just rip it at some point to the upside. I know a lot of people are like, well, when? And when's it going to do this? Guys, I don't know. I don't know when. No one knows when. The patterns are forming. That's what we can say. And we know that a lot of these things are breaking out. Maybe it takes a week. Maybe it takes a year. Why does it matter? Because the patterns are so large. The upside is so large here. And we're getting a confluence of events across all of the commodities markets. You just have to be patient. You have to do whatever the market's going to do. It's just the way it is. It's the game. UROY also breaking out. He says often a proxy for uranium price is breaking out. That looks fantastic to continue moving. Hopefully we get a massive move. Now here's one. This is the typical rental property we buy. It means $6,000 a year in cash flow, $8,000 a year in appreciation, $2,000 a year loan pay down, and $16,000 a year wealth gain when you add that all up. We will soon own 10 of these properties. And what he's essentially doing is he's increasing his pay. So let me say this again. So he goes out there, and I'm not saying that there isn't risk associated with this. There's definitely risk if you're acquiring properties with debt. But when you acquire properties with debt, what you're essentially doing is increasing your pay when you have people paying you a rent. So if you have 10 homes and all those 10 homes, let's say each home is a $3,000 rent, that's $30,000 per month that you've increased cash flow to things that you are paying down or paying off. So the cash flow's killing it. And he's talking about positive cash flow. You got appreciation of all those assets that are out there. And you're also paying down the loans as you pay it down. You are incurring a lot of risk if you're doing this with a lot of debt. Because if something goes wrong, something goes backwards on you, it can collapse on you. So that is the risk. But if you don't push your debt levels too much, and let's say a strategy could be let's get a bunch of one bedrooms or one bedroom apartments, small little places that you buy, and you rent those one bedrooms out. You're not going to get killed if one of them isn't being rented out and you had to cover it. Especially if you've got enough money saved up and you can kind of weather some storm. And that's why you have a bunch of smaller units that are diversified out that you're collecting a bunch of rent from. If one of them doesn't pay, you can use your cash flow from the others to cover it. So that could be one strategy that one could deploy. It's the problem is if you get these really large buildings or large single family homes and it doesn't get rented out, you're stuck with paying a larger thing. You can't really float that cash flow around to cover some problems. You can't really diversify as much if you're just starting to start something up. Here's Sprott Physical Uranium Trust. The race is on. It's ready to break out here, which we're breaking. It's looking fantastic. In 3 words, why did you start investing? So 3 words. I'll say want happier life. There you go. I want a happier life. Coming on down, it says all this damage in tech is going to take a while to repair. I'm not expecting tech to be the leader again anytime soon. You can see this is coming down. Technology versus the S&P 500. This is also a signal of where we are in the market conditions. When technology underperforms other assets, that's generally in a rising interest rate environment, and that's exactly what we're seeing. So this is a function of the environment. Base metals should have a nice run in Q4. Copper on the verge of a breakout. Steel looks healthy. Looking good, guys. Let's turn this up and turn these commodities to the upside. Guppy says, buy inflation. Buy it till your mouse breaks from smashing the button. It says Goldman Commodities Research Chief Jeff Curry set to leave the bank. So it looks like he's leaving the bank. Analyst known for making bold, often bullish pronouncements is leaving Goldman Sachs Group. Platinum is flat today and gold is down 40 basis points, yet silver's down greater than 2%. COT positioning is much more bullish. And with employment weakening in the U.S., silver is primed for an epic squeeze. But a lot of people say this over and over. I don't really care about the squeeze. I don't really care if it happens a year from now or 2 years or 3 years. I'm going to continue to buy silver irrespective. And I look at that as, I don't look at it as insurance. I just look at it as money out of the system. And I just don't like money being all in the system. So I like being diversified. Energy stocks turning up relative to large cap growth, XLE versus IWF. There's your bottoming and starting to turn on up. You can obviously see a downtrend line break. So that's looking good. Hopefully energy outperforms. I'm very much allocated to that sector. We've got nothing to see here. Move along. This is the magical crude oil. Open this bad boy up. Paradigm shift on the breakout line. So we broke out, did a retest move, and here we go. Starting to move up, and we're starting to get above the massive volume base. So this is where all the buyers and sellers are located, looking across here. We're getting above all that, and once we get above that, I think we're going to run. Dips are getting bought so far above the 4-year moving average. Fast MACD wire starting to turn up as well. Well, let's rip this beast, guys. Let's rip the magical crude oil. Grady he said they called the agricultural bear market low back in June of 2020. And that's a proper call, not some vague question mark thing. The narrative now is that inflation is backing down. It is not. This chart says second inflationary wave is incoming. Get ready, guys. This is DBA. This is a nice little kind of loop. I always see this loop. What he's got is an inverse head and shoulders. It's a loop here, a big head and a loop. We're seeing this all over the place in a bunch of different commodities. We're seeing it. I see it a lot in energy, oil, gas, and energy service. Tons of inverted head and shoulders. You can even see them in gold and silver in some areas. So 11-year expanding falling wedge as well. We're ready to rip this thing. Let's do it. Here's commodities. North Star says if we get this signal, commodities may well outperform gold by 200%. Imagine the inflationary pressures that would imply. So commodities priced in gold, that's the CRB index versus gold. You've got this big downtrend line, and we could potentially break here. If we move through this breakout, this move through here for a massive confirmation signal, a 200% move to the upside at that breakout. And what he's looking at is an inverted head and shoulders. It's a shoulder, a head, and a shoulder that is playing out right now. And if it breaks to the upside, boom shakalaka. That's all I'm going to say is boom shakalaka. And all the indicators are indicating that that could happen. Looks very good. And then that's where we're going to end it, guys. So that's what we've got for today. That's what Twitter is sharing. And a lot of big picture view for commodities. I think it's all ahead of us. We just got to wait. That's what investing is. You take your positions, you sit in it, and then you wait. And it's pretty boring, guys. It really is. Like, to be a really good investor, most of the time you're just sitting here doing this. You buy a bunch when things are down, and then you sit and twiddle your thumbs. Yes, there's some good things that you can buy that are lagging, like energy service companies. But at some point, we're going to start running out of stuff to buy. Like, not everything's going to stay low forever. And at some point, when these start to work its way up, we're going to be stacking cash and waiting. Now, we're not there yet, but at some point, we will get there. And maybe it's a couple years out. But a lot of these companies are putting in gigantic inverted head and shoulder bottoming patterns. Drilling companies, exploration production companies, and oil and nat gas. It's all over the place. Oil and gold and silver companies, some of them are doing it on a falling wedge. They put in a nice little inverted head and shoulders. We've got double bottoming patterns in rare earth metals, and copper's got it where we've broken the double bottom and we're consolidating on it. That's considered the ideal buy point. These things take time to play out. They are not fast. And the accounts will be volatile. It's the way it is. It's the game. Learn the game, get the best that you can be at the game, and then dominate the game. Domination generally indicates that you have to be very patient. It takes years. And some years you're going to be killing it, just absolutely annihilating it. Other years you might slow down as it pulls back and into a little bit of a pullback. It's the way that the herd behaves. It's the way that they interact with each other, and that's just the way that markets behave. So that's what I've got for today. Thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. And we'll catch you guys later. This is Finding Value.